I'm Todd Olson, Head of Partnerships here at Triangle. Thank you everyone for coming. Thank our partners, Turtle, Infor, and Toro. I will let everybody give a quick intro of themselves, then we'll get started. So want to go right down the line? Chad, go ahead.
Yeah, quick intro. Oh, okay. So my name is Chad Jones. I'm CEO of Plusso Ventures. Kind of got to the climate side of things through an interesting path. I came up through tech. I was building systems for clouds before clouds were clouds in the 90s. Yes, I am that old, Botox aside. But I ended up getting acquired by private equity, started to understand what acquired means and what equity meant. And that was kind of a cool thing. So I decided to watch, rinse, repeat through the software SaaS side of things. Built technology, exited to Microsoft, built another one, exited VMware. Then I built an IoT cloud, and we exited that to Google. Actually, that's now part of IoT cloud itself. That was called Xively by LogMeIn. On the way there, I started a small family office, did some chronic care stuff for healthcare for a while, but then jumped into microgrids and really got my eyes open to some of the power needs working with more impoverished areas, especially Native American nations, Hopi, Navajo, things like that. If you want to see true poverty in this world, go on Res, and see what happens there and see what the lack of power that they have and the lack of resources and access that they have, So that kind of caught my heart, started working on those types of things. And then, met a partner there that I partnered up with. Now we're now doing biogas inside of India. So we take these biogas plants, anaerobic digestion. We take sugarcane waste, some chicken litter, manure, put it all together, and we make CH4, highly pure CH4, inject it directly into a pipeline, get paid by the Indian government every 21 days, like clockwork, which is great. The fertilizers completely that we make as well out of that process is fully organic, 30% crop yield increase while saving 10% of water. And then the carbon credits come on top of that. Now, most of what we're doing is very much focused on the cash flow of the business first and foremost without depending upon carbon credits. Because at the end of the day, there you have to attract investors, and investors have to be able to get a return. Right. And that's the first order thing we wanted to be able to do before we started claiming the good of the carbon credit side, which becomes an upside, to these things. We partnered with Triangle to be able to bring those carbon credits out of market, not just in a way that we were able to get them to market, but in an efficient manner that we generate these things and they're able to quickly get to market to start to do good. But the nature of these things where they now become a regulated asset that can go on your balance sheet. Oh my gosh, that completely changes the game, that we see. And we're really excited to be part of that chain in that brave new world.
Excellent. Tommy?
Can't follow that.
You're British, of course you can.
Yeah. Ray?
I sold my first company to Amazon and my second one to them.
Yeah.
Tommy, I'm English, actually a New Zealander. I run B0, we're a carbon rating agency. So I founded us about 5 years ago, trying to bring, I was an ex-analyst at the bank, trying to bring the rigor of financial analysis to the way in which you think about it. Carbon credit. So if someone says to you, I'm going to sell you the best credit ever, you go, sure, but how do I understand that at more systematic level, not just like reading their marketing brochure? What we do is to independently, it's like S&P's business model, same thing. We independently assess projects, sell them as ratings, those ratings at AAA to D. It's as much to do with the analysis and the system analysis as it is to do with the actual output. The output helps provide correlations between price and quality, so you can actually have like a functioning market curve. We have raised a bunch of money and spend it on tech and all kinds of fun scientists. And basically we work in London, but we have an office in New York. We have hyperscalers as our client, and we're trying to really basically disrupt the original statement in the carbon credit that every credit is a ton. Because basically, listen, I'll finish the point being, you can't physically deliver carbon, so it's not a commodity. It's not just financially settled, so it's not a bond. It's something else, and it's not really either. So we have to kind of think about being a bit more imaginative how you do that. But if you want to get over greenwashing, the way that you talk about that in financial markets would just be risk, right? Obviously, there's a risk that you default, but it doesn't mean that you're therefore a criminal. There's a risk that you would be delinquent, doesn't necessarily mean that you're therefore doing bad practice. So just trying to change the language from sort of boom bust, one or zero sort of stuff to just being sort of probabilistic. So it is still very controversial what we're trying to do, because a lot of people don't come out on the right side of that grades, and they're not obviously best pleased with us. But yeah, no, this is it's nice to hear a room of people that I've never seen before. So I do a lot of these things, and Bank of America was my old employer aside. It's very good to hear the energy and the sort of enthusiasm coming through from you guys, because that's you know, I'm a weary carbon markets like circuit person, and this is very energizing to see a bunch of people that I've never met before. So welcome to this very niche debate.
Right. Yeah, this is challenging. So I'm Ray Wood. I work for the small boutique investment bank called Bank of America. I run what we call NET, which is natural resources and an energy transition. So I've got a power background, not an AI background, but now we're all data center AI bankers. And so grew up doing unregulated power generation when the monolithic utility business was broken down with deregulation, both us on the gas and electric side. And now we spend our time across the full value chain, and it's really interesting. There was a wave of gas, and there was a wave of wind, and there was a wave of solar with storage, and now gas generation. If you look at Vernova stock or Siemens Energy stock, gives you a sense of the prospects there. We're whether it's the next generation, geothermal 2.0 or SMRs or fusion, the amount of baseload power coming from decarbonized sources is awesome. How all this fits in with the carbon markets is that, if Texas, one of the biggest power markets, that's 150 gigawatts, there are some consultants who think that capacity will double over the next 5 years, which is a pretty crazy thing to think. The most conservative forecast out there is 13% CAGR. So figure that's like a 65% 5-year growth rate, maybe 70. So incredible capital coming in to grow. It's going to be all of the above. And carbon capture technologies are coming to their own art. And given the higher price for power for AI and data centers, there's ample room. So there'll be a new supply of carbon to be traded and to be priced. And a lot of the hyperscalers don't want to admit they're buying baseload energy from a coal plant. They're willing to pay a price for power that incorporates some of that carbon-free attribute. And so there'll be, whether we need to develop separate carbon markets for that, or whether they will want that carbon and monetize it. I mean, there's a lot of business models there, but that's where we're spending time, and look forward to a spirited discussion.
I feel like I need a long intro now.
That was a quick intro.
Yeah.
Panels up. That was a lot of fun.
I'm Mahir Dage. I'm the CEO of XCF Global. We recently went public on the NASDAQ about 3 months ago as one of the only pure play sustainable aviation fuel companies. We're really trying to embrace that ethos. The goal is to be one of the most scalable SAF companies in the world. I spent my career 15 years on Wall Street trading commodities, so I have a good understanding of how, call it, the non-feedstock world works. And then spent 5 years in government regulation, putting in taxi regulation to help the MARP or the MRP program, which helps standardize taxi medallion values to help. Really, the goal was to electrify the fleet and create a standardized trading value around it. About 3 years ago, I was asked to be the CEO here. We had a renewable diesel project in Reno, Nevada, and we wanted to convert it to SAF. We noticed that we thought that the forward momentum around sustainability was going to be very important, and especially around these projects. So we created the 6th active facility in North America, in the United States, and one of 41 today. Super excited. We're right at the beginning of the journey, but it is a interesting process. You learn a lot through what's happening with the credits, and SAF in particular is very bifurcated. So it's bifurcated on offtake, on scope credits, RINs, LCFS. So there are all these different elements that drive value. But I mentioned it to you before, we're still in the business of climate change. So we have to run a business first, which really embraces the climate change second. So we're super excited. Thank you for having us.
You're welcome. I'm going to run this like a fantasy football draft. So I'm going to go back because now we're out of order. So we hear, as a newly public company, are you finding it easier to raise capital for new projects? And if not, talk to Ray right next to you.
Actually, it's really rough. We heard Bank of America was very interested.
Absolutely.
What we're actually noticing is that there is a lot of capital for deployment. The United States in particular, I think there's just a watch towards what's happening on tariffs, what's happening on the regulatory scheme before people call it investors jump into the market. Internationally, I think it's probably well understood what the mandates are and what the driving force is. And since we are in a, call it drill, baby drill type of environment, we are noticing capital is patiently watching where it should flow. So one of the impetuses for going public was to really tap into the public markets to open up other options and opportunities. And we are seeing that you have very traditional types of structures like converts and ATM facilities and all the different unique things because there's a liquid currency around it. So that was, that is one of the driving forces of why we went public. We have been able to tap into other, call it structures and vehicles, and we're going to use that as a growth mechanism for us.
Great. Do you anticipate either carbon credits or staff certificates being a significant part of revenue or just kind of additive?
So I kind of alluded to the fact of how SAF is a little bit different than some of these other things, right? When you produce a gallon of SAF, you produce a RIN. That RIN has to be registered within 5 days. For us, it's a D4 RIN based off of the pathway that we use, which is technical corn oil. And then you have a scope 1 credit, a scope 3 credit, and then if you move it in California, there's an LCFS credit. And then you have a 45Z. So in terms of the credit stack, right, there are many things that are happening. The one is you have somebody who's willing to offtake a portion of it. So they're willing to take the molecule. So they're willing to take the molecule and I keep the credits. The other is we have some people that just want to buy the credits. I blend the fuel and then I just deliver it locally or deliver it where I can get maximum value for it. So SAF to me is a little bit more of a puzzle, a little bit more of a different structure, but we're noticing just from both sides, there's a lot of interest and more from book and claim today than before.
Excellent. Ray, you knew this was coming.
I did.
You're supposedly a solution provider to clients.
You're supposed to laugh.
What types of assets are you looking at now? What type of large project are you looking at now and how are you looking to grow your business from here?
Right. I mean, it's interesting because with the equity markets are enamored with this power demand story that I mentioned in my bio and in the intro. And so there's a lot of capital. And at first that's equity capital, venture capital, then it's post-venture, pre-IPO, emerging growth, all these. So that goes from like a 30% return or 3 to 5 times your money to kind of a 20% plus return. Then as they're putting out pilots, technologies, new generation, liquid, renewable fuels, what have you, it gets to be more structured equity. It might be a pref equity at an operating entity with warrants into the top co. So if you're taking some of the early risk, but you're still protected in some sense, you've got cushion. And then ultimately, as this becomes mature technology, the deployment capital, as you articulated, is there in spades. It's there from pension funds, sovereign wealth funds, insurance companies, infrastructure funds, public equity markets, and then the debt funds are all there, private capital and traditional rated, unrated banks, blah, blah, blah. So there's that flywheel of capital is once you get out on the other side. The real challenge is in between that growth technology phase and that deployment phase, where if you don't travel down it, the amount of equity you need to prove out your technology, really dilutes the economics to the founders and to the venture capitalists. So that's the trickiest part of this kind of flywheel for capital is on that. We're seeing an awful lot of that. The IPO market's back with a vengeance. Just pick up Barron's or the Wall Street Journal and you hear all about it. Things are up. There's a little bit of froth in the market potentially. And interest rate cuts help. And so we're doing an awful lot of pre-IPO capital. Then there's IPOs, there's a second generation geothermal company, these new, Okla's trading publicly 20 billion. I don't know what it has in terms of operating assets. So there's a fair amount of anticipation in some of these transformative technologies that are also backed by the current administration's view of the need for base load, non-intermittent power. So you have traditional bank lending, bonds, but the biggest part of our business right now is probably strategic combinations or private equity buying in to that phase where it's getting to pre-IPO growth, or private capital, and what it takes to put a nuke or a combined cycle power plant with 100% redundancy, or something else next to a data center. These deals, you saw there was one deal announced for a wave of data centers. It was 29 billion of capital committed by Blue Owl and PIMCO. So these are pretty big numbers.
It's crazy.
It is crazy. It's really hard to get your arms around that quantum. So there's all that excitement. Utilities are trading very well, and so they're raising. All this stuff means there's be a lot more generation, and hopefully clean or using carbon capture, because I think the demand is there for that, and the price signal supported. But also, utilities have to build out the grid, and they. Every state, every governor wants to entice data centers and AI jobs to the extent there are any, but they also don't want to raise utility rates by 15, 20% a year. It's a highly regressive form of taxation. So there's going to be a little bit of a kabuki dance in each state about how do you socialize those costs and who's going to pay for it. So utility stocks, because rates are coming down and because they're talking about growth, they're trading near all-time highs and they're issuing a lot of equity. So right now the market's, notwithstanding, Liberation Day and the disruption we had in April, it feels like everything's a slog, but there's a lot of activity. And I've never seen kind of this much capital being contemplated in the space, and I've been doing this for over 30 years.
Well,
So
let me ask you. So the narrative has changed from the last administration to this one.
Yeah.
You've been around a long time in a good way.
thank you. Yeah. You can translate that as something else, but I mean, thank you.
With Brian as head of the bank, with Brian as the head of the bank, how are you tackling those narrative changes, inside the bank? And what do you think your next opportunities would be very, very quickly? Because we got to get there.
Look, it's a great question. And, no one really wants to draw attention. And you saw late night hosts drawing attention, they get suspended, and bankers drawing attention, they get chastised. And look, that's a dance too with the administration. And so we're just trying to understand where the administration wants to go. On the other hand, demand for these products exists, notwithstanding whatever President Trump said to the UN yesterday, right? So let's just keep dancing together,
Let's keep the music playing.
Yeah, exactly.
Tommy, from your perspective, how do we get more capital and velocity into the carbon markets?
Very small fry versus the hundreds of billions that Ray's talking about. Okay, so there's 4 reasons you buy carbon credits. There's philanthropy. There was corporate claims. So I'm doing good by my Mars bar or whatever. SBTI or transition framework alignment. So I signed up to this thing and I have to do that. They actually don't know people say buy credits, and compliance. It's only 4 reasons as far as I can tell. Philanthropy is not a market. It's good, might as well invest in mental health, right? It doesn't mean it's the same pot of cash that's coming out. Claims is dead. There's a very interesting court case going with Delta at the moment about a lady saying that she, bought these tickets thinking that they were going to be carbon neutral, and I was asked to contribute to the trial, and I obviously said absolutely no.
Smart move.
I do not want to be in an American trial. And then SBTI. So
Not as a defendant.
I don't want to be in the American courts. Okay, so SBTI, we calculated 15% of Scope 2 emissions SBTI line. It's about 6 billion tons, $1 billion market overnight if you price that at $15. To give you a sense of what that would mean for the carbon market, that's about 1.5 times the number of jobs in oil and gas globally. That's 700 billion of deployed capital annually, and 60% of that goes into global south. So these are not like one fell stroke of a small NGO's pen saying that corporates should be buying credits. in their scope 3 allocation, which probably won't happen. But if it were to happen, that's why you get so much interest in this market. You have very, very asymmetric type outcomes. And so everyone got in 2020 thinking this is going to be a really cheap call option on the growth of climate liabilities. And that call option is just more and more out of the money today, unfortunately, but it's still there hovering over the market. So one small thing now on compliance levels, if you say, you have to, you expand the scope of cap and trade, you allow credits to be used as eligible instruments, you could have a similar sized impact, even potentially higher impact on some of these schemes. So, what would do that? Well, I think that there's only really one outcome. It's the path to institutionalized financialization. That's it. That's the only way it works. It's got to be regulated. It's got to be boring. It's got to be a price on the front page of the Wall Street Journal or the FT. It's got to have all the right, bankers in the room making this stuff. And, I think your Aussie analyst said, it's a CFO problem, not a CSO problem.
Exactly.
This is just the way it's got to go. Now, the question is, will the people that got the movement here be prepared to let go of the reins and let the boring capitalists in? That's kind of what's been jockeying the position right now in the kind of climate community. But it's nothing particularly magical, right? It's all the stuff that we have all tried to build in every other market, from derivatives in the 90s through to everything since. And that's just the way to go. It's just the question is, how long does that take? And are the governments going to actually, which is the bigger question, it's implicitly a tax on the consumer or a tax on business. It's not. It's just you're not paying for that cost anymore. But the politics of that is very difficult. So the politics of being, so that those politics have got to be aligned to this. They've got to see it as a growth opportunity, not as a cost on the electorate. And then you've just got to institutionalize it. It's not that. It's quite a boring set of resolutions. It's just that takes a lot of energy, a lot of hard work to get there. And it comes from a weird place where this market was genuinely built by NGOs. There was no other financial-esque asset that was built by NGOs. It just doesn't, that combination is very idiosyncratic.
Come from that side. Do you think of any other barriers that might need to be removed to help this market grow?
Not without going into all the boring minutiae of the detail, but it's mostly, people, the accounting treatment, about how, your point about asset, balance sheet assets versus non-balance sheet assets, is it real or not asset, i.e. would you, the way you teach people, all these things need to be put in place. There's no real classic definition of a carbon credit. So that's a lot of debate. There's a few court cases that has to be real where you can't deliver it, so it's not real. So it's like a fallacy built into the way the legal systems work. So there's that side of it. And then practically speaking, you have to come to an agreement on how it's going to work, right? Are ratings part of that? Is it probabilistic? Is it a commodity market? Is nature in? Is not nature in? What level of uncertainty is appropriate for these things? These are all the stuff that's...
Yes, there's a lot of confusion that needs to be kind of alleviated before it can really grow. Chad, you're tackling a large project in India. How are you mobilizing capital for the opportunity?
So we started with, we wanted to prove the concept first. So we bootstrapped for the first plant. I got nickels and dimes out of my partner's couch, down at that level, and we got it all together, and we got with some partners and got the first one done. We wanted to make sure that we proved the concept, and we knew we had a really good thing because my partner took a year and a half and looked at why every biogas plant, or most of the biogas plant failures occur across the world, right? It's not just India, it's Germany and US and all these sorts of things. And we found some very clear-cut examples of why they fail, right? And a lot of them too were starting to depend on carbon credits as a source of revenue, but investors look at it and go, well, wait a minute, carbon credits may or may not get you something. Where are you going to sell it? All of that. We have a great answer for that now, but that's still not something that you want to bank on. You've got to go bank on cash flow, real cash flow, because investors have to see an ROI, right? In a real one, and then de-risk it. Investment's all about risk and all that stuff, right? So we went in and we made sure that all of those things first, and then our forecasting models only forecast about 10% of carbon credits upside, right? And so we show tremendous, IRR and all of that very quickly. And we have a model where we turn those things, turn the plants and stuff like that. So the return is great. But then if the carbon credits get worked out, the upside is tremendous, right? So that we flipped the script on that. So now we have a lot of interest. We're raising equity right now. So we've got a lot of interest because we came at it from that way, business first, right? To your point, you said before, it's a business of climate change, right?
Actually do something.
Yeah, exactly.
Yeah. Well, you answered my other question about seeing carbon credits and the other attributes as additive to your business slightly.
Yes.
But what other opportunities do you envision for your business right now?
Well, for our particular business, it's interesting because there's a feedstock that you have to put into biogas plants, right? And we're using sugarcane press mud, which is out of the sugarcane process. You know, India's got a big sweet tooth, so they process a ridiculous amount of sugarcane. So we put that in, and we put some cow dung, chicken litter, and that creates incredibly pure gas that we put into the pipeline, get paid for. But it creates a fertilizer that the nitrogen to carbon ratio is off the chain. I mean, it just actually blows Scott's Miracle Grow out of the water based on just organic stuff. So that's a really interesting upside. We're going to bag that stuff, get a NOPE certification, export it. Hopefully Costco, Tractor Supply picks it up, stuff like that, right? So those are the opportunities. But ethanol plants create a spent wash that's perfect for biogas. Right. So India has this massive push for ethanol plants as well, and they're putting their mandates up. So put a ethanol plant, take the spent wash, put it into a biogas plant, and you get everything you need plus a compounding effect on the actual revenue from the cash side. So those upside opportunities are quite interesting to capital, as well, especially on an equity raise. So we're pushing from that side.
Hey, Ray, what does the bank think about tokenization? Where are they going with that? Have you had any of those conversations?
Yeah, I mean, I think it's, we love things we can trade, so selfishly, we think that's a great idea. We like that a lot better than taxes. So, I mean, to give you a low ball. But tokenization, to the extent it can create a more uniform product that can be traded, then I think that liquidity will do wonders in the market. Because I think there are a number of technologies now where it makes sense to deploy capital to capture the carbon, and then tokenization will just accelerate the ability for people to monetize that. So we're had to say hello.
And Tom, you talked about it briefly, carbon commodity, maybe not, but it's not deliverable. So we think that's why it's perfectly digitized. I mean, how do you think about that?
So there's a few,
As opposed to the early PDF getting sent when you bought something,
Yeah, no, I understand. I think the different parts of the value chain are more applicable to that than others. So the registry technology, which people use the ledger, if you create a credit, it'll go on the ledger, and then basically depending on who buys it, obviously all that sort of stuff is perfectly right for blockchain. ACX, which is a blockchain-based carbon exchange.
We know them well.
Yeah, I know. Yeah, I know Bill very well. First ever ratings on an exchange was on ACX.
Yeah.
And I think that they've shown that that's a model that works, but I think they've found it struggled to differentiate themselves from just the classic sort of infrastructure.
Yeah.
There have been some looking at using it for like tokenized credit-linked tokenized trading, and that was quite a thing for about a year in 2023. And Newman then came in and I think maybe burst that bubble. But then he gets sort of weird things around bridging. So if you create a digital twin, how does that link to the real twin? And then the registries that are owning it were like, a fantastic journalist basically made the point that this was double counting. It wasn't. But since then, it's been impossible to come back. It's just killed it, basically. So I think it's practically speaking, a very good competing solution just for the transaction infrastructure, reporting infrastructure. There's good use cases in tracking data in the field. So putting it onto the chain and having it there. I think those are all very good use cases for it.
Here, I'm going to ask you the same thing I asked Ray. When you started XCF to now, the narrative changed a little bit. How are you adapting the business to kind of change the narrative? I should have told you that ahead of time.
Yeah, you should have. Well, I think observationally, there were three buckets of capital that were kind of moving consistently. It was venture-backed, private equity-backed, and IPO market, right? With the IPO market kind of being like the holy grail. We're noticing that venture-backed and private equity-backed investments, especially from administration, are potentially getting locked in investments. And I think we're seeing a huge, resurgence in the IPO market for liquidity purposes. If you took like a finite set of all currency, and it's because of digital currency. The digital portion is really pushing liquidity. It's pushing the boundaries, which is now pushing into this sense that liquidity is more important because you can still have innovation in liquidity. So my observation is that's what's happening, and that's one portion of it. And then the other portion is that AI is really pushing the boundary of infrastructure. So we're going to either have very specialized type of labor, or we're going to have very infrastructure dependent, and those are going to be the battlegrounds. So we have kind of our passion, our vision is still around SAF, but I think we're starting to try and figure out how the infrastructure portion is important. And in the United States, we basically don't talk about that we're green, we're fossil, we have some type of fossil dependency. Whereas internationally, there's a focus on it being a low carbon fuel. And then you kind of lay on top of that, like, what is the future growth pattern other than volumetric production? Are you thinking about innovation around some of these digital assets? So I think you have to take a little bit of what the trend is and then overlay it with your business, which we're trying to do.
Chad, as a building projects in another country in India, seems like you got some regulatory tailwinds. How are you taking advantage of that?
Well, there's the SATAT program, which is the government's push for biogas, right? So we have every advantage inside of there because they want this to happen. So the government buys every kilogram of gas we can make, as fast as we can make it, which is great. And then they're pushing, starting to push fertilizer mandates that get our fertilizer bought, to put into 5% displace urea, stuff like that. So that all works really well for us. And they're supposed to do 5,000 gas plants by 2024. There's 108. 108. That's it, right? And we're one of them. So, and we're the only one that's direct connected to the to the pipeline, right? So the upward bound of that is, for a budgeting perspective, all that is massive. You also notice that there on the site, you can see LOIs. So there was a lot of LOIs that came up at first. I saw it as high as 4,980, right? And now if you look at it, it's down to 1,200, right? Because people aren't, they're not getting the funding, they're not getting things they need because they don't have the right approach. You have a lot of people that went and said, I'm going to build a 100,000 cubic meter plant, and they can't feed it. They trying to do casts, they can't, they can't even, if they attach to the pipeline can't take it, so they're way overbuilt, right? Or they try to just do it purely on cow dung and it doesn't give them the right thing, right? So trying to put all of that together, right, and make the right package, and then put it into an environment that's incredibly friendly for us. It's great. And since we've done that, nothing's quite like being successful in India to have everybody rally around you. I mean, we have the governors of different, of the states. We have the Punjab governor comes in regularly, takes pictures, at the place. We get, Modi's actually mentioned it. We've got a bunch of press coverage. Every time the election comes around, we get mentioned. All that sort of stuff is a success. So it makes it a lot easier, of course, inside of there as opposed to some of the other nations.
Awesome. Tommy, the carbon markets in Europe are way more developed than they are here. Do you ever see those converging?
The voluntary or the compliance?
Voluntary, sorry. That's what we deal in, that's right.
Yeah, I think I had it said to me that the US is much more concentrated. I'm not sure it's necessarily less sophisticated. It's just much more concentrated. There's fewer buyers, but people buy a lot.
Yeah.
It's not, Porsche's always bigger here. But in Europe, I think, there's more of a culture across sustainability groups of buying these things. They've got lower margins in businesses and they're more skittish in terms of their vulnerability to bad press. So it's tricky. I wouldn't say that I wouldn't actually say that that's necessarily true. I think that the US hyperscalers are really trying to push a different sort of vintage of buying behavior here. But yeah, I mean, one thing that's really interesting, the banks have been whipsawed. They all came in late and all have left because they basically, with very few exceptions, they saw the thing surge in 2022, set up a desk just as the thing plunged, lost 2 years and all left. So that's an interesting trend. That's very different from the commodity houses, some of which have been doing this forever, some of which are coming in a bit later. A lot of people are moving into sort of upstream financing, basically. That's where a lot of the action is. There's been a bunch of funds being raised recently, including a couple in New York. So yeah, it is changing, but I don't think that there's more of like, the corporate buyer is probably more diverse in Europe, but it's certainly, I would say that it's very much come along a lot in the US.
Excellent. I know we're getting late. Any questions from the audience? We just covered everything so well. Peter.
Viable minimum plant size on what you're doing. I agree with you. I've seen deals forever. People are 1,000 tons a day. I'm like, that's 1,000 freaking garbage trucks going through, so 500 a day going through someone's yard.
Yep.
And unless they're already going there, you're screwed.
Yep.
What's sort of viable minimum size you guys can deal with and the maximum?
Right. So the production plant we have right now is 14,000 cubic meters. And it's because we sized it to the availability of feedstock in the area, in the local area, right? We don't want to truck this stuff in forever.
How many tons of feedstock per day or year would that equate to?
Oh, geez. So a day, I got to go back and look, I don't know off the top of my head. But then the plant sizes that we find are the optimal ones going forward in our forecasting are 21,000 cubic meters. And if you we could go up to 28,000, but we don't want to go beyond that because then it's the feedstock side. Now the ethanol side of things is different. If you put a 125,000 liter a day plant, right, we can turn around and feed three 21K cubic meter plants for biogas, right? And it'll all be perfectly balanced and we will use every bit of that feedstock. We'll still mix in some chicken litter and cow dung because we want the digestive for the fertilizer properties of that.
Can you do that for, the 15 major ethanol producers in America?
We could, absolutely. The reason we're doing it in India is just because we have those political headwinds or political tailwinds, and we also have we have an offtake right immediately, right? So if there's offtake here that could do that, we certainly could do that. That's just the challenge differences.
Anybody else? Questions?
I got one other comment. Oh, if you don't mind.
You got time? You got time.
Yeah, in raising capital, there's a whole section of the markets that aren't willing to even look at these things. Venture capital, early stage. A lot of my career has been done on seed capital, early stage stuff. And I brought this to them and I'm like, look at the cash flow, look at all this stuff. And they're just like, nope, not going to touch it. I think we have to get to a point, and you had said this a little bit earlier, is, we've got to move the Overton window on the perception of this stuff. And if we look at the past in the US, right, we have, I like how you're like the hippies who want to need to let go of the reins to the capitalists, right? Well, the hippies are a little more authoritarian and says we have to do this because the RCP 8.5 model that all the politicians on the left in this country come out and say 12 years, the whole planet's going to burn. And then it doesn't come true, right? It doesn't move in that direction as fast as they say. And most scientists are RCP 4.5, RCP 6.0. Okay, great. But the other side of the aisle looks at it and goes, "See, I told you. What are you guys doing? This is all bullshit. I don't want to have anything to do with this." And then you have division, right, and conflict, right? And the first order principle has to be we have to decarbonize this thing. Well, what's going to push that? Well, if you make it boring, you make it a tradable thing, and you let the boring capitalists come into that, right? Not advocating for capitalism per se, but that's what's going to change it into something that goes on a balance sheet. People will buy that. Then it's no longer be perceived as this green thing. It's just going to be part of the transactions. And that's what we have to get to. And both sides won't care at that point. It's like when I used to do the IoT stuff, I spoke all over the world about IoT when it was emerging. And my first thing I would say is the Internet of Things is irrelevant. Good night. And everyone's like, what? It's gonna be $1 trillion markets. I go, well, the point is that if I just internet connect something, its value is almost worthless. It has to be in service of a greater business case. Technology for technology's sake is doomed to mediocrity or failure, right? It's the same thing with this. Everything's internet connected now, but do you see anything that says now IoT enabled? Of course not. It's just a feature of whatever that is, right? That's where we have to get with this. We have to flip the actual narrative on this so that, hey, I buy a gallon of gas. Of course, the carbon offset's just part of it. Of course it is, right? It doesn't matter. It's just, it comes part and parcel with every transaction, not glorified or vilified. It just is, right? And the only way you're going to do that is through the office of the CFO, right? If I have tradable asset that I can actually bank on, I can leverage it. I could go collateralize it for loans. Is it going to get to that point? Then why wouldn't I have this? And why wouldn't a more conservative CFO say, hey, that's a great thing to go after? That's where we got to get to. Once we get there, then that flips the entire game, right? And, you know, hey, I'd like to be virtuous too and say, hey, let's go save the planet. And that's what we're going to do in the end. But what do we care about more, saying it or actually getting it done, right? I'm on the camp of let's go get it done.
Yes. All right. Yes.
Darren wants to do some closing remarks.
Let her know.
We're going to the bar.
Yeah.
That's my closing remarks. Let's go to the bar.
Yeah.
Again, for everybody for attending,
Even better on
also to our partners, Infor and Turtle
Yeah.
and then Toro. And Tom, good to see you.
Yeah.
Thanks for
So
coming.
everyone, thank you. Thank you to the panelists. Thank you, Todd. Great job. Thank you again to Infor, to Turtle. It's great to, this being our 4th year, working with our partners. And let's go to the bar.
Yes.